So what's harder to control? Inflation or your neighbor's loud music on a Tuesday night? Well, right now, the Fed might say inflation. But I don't know about you, but both of these are testing everyone's patience. So before you place your next trade, you would want to watch this. Good day, everyone. Francois here, your market analyst here at ATFX, bringing you today's daily market brief. We've got three hot topics lined up, starting things off with USD CHF, then moving over to silver and the Nasdaq 100. And trust me, each one has its own plot twist today. Let's kick things off with USD CHF. The US dollar is showing resilience even after the Fed's rate cut last week. Normally, cutting rates make a currency less attractive. It's like turning down the volume at a party. But instead of leaving investors actually turned up. Treasury yields on both the 10-year and 30-year bonds moved higher, which tells us bond traders aren't fully buying into the Fed's dovish stance. They are worried. Inflation hasn't been tamed, and let's be honest, US physical conditions aren't exactly inspiring confidence either. Add to that the drop stronger than expected, weekly jobless claims, and a rebound in the Philly Fed Manufacturing Index, both giving the dollar a solid boost, suggesting that the US economy still has, well, some strong stamina. On the Swiss side, things look less convincing. Inflation has slipped into deflation territory. Consumption is slowing and growth momentum in Q2 has weakened. Markets are even whispering that the Swiss National Bank could move rates into negative territory next week, something that we've been reluctant to do given the risk to savers and pension. But with CPI and PPI failing, pressure is mounting. That's partly why the franc safe haven glow has, well, slightly dimmed. Looking at the charts, USD CHF has bounced off multi-year lows at 0.83 and is holding above 0.795. If buyers hold this ground, the pair could stretch higher. However, a dip back under 0.792, though this would put 0.783 back in play.
Why is fast trade execution a must? Because you're more likely to get the entry price you want and the exit price you want. Reliable, rapid, responsive. Join ATFX today and let's get you started.
Now moving over to silver, the breakout star of the commodity stage. It hit $43 an ounce, its highest in 14 years. And yes, I know I said that last week, but it's again at a new high point. This isn't just a rally, it's a full-blown comeback tour. Fundamentally, silver is benefiting from multiple tailwinds. First, the Fed's rate cut. Lower yields make non-yielding assets like silver way more attractive. And with the possibility of 2 more rate cuts this year, the case for metal just strengthens. Secondly, supply remains tight. Not just a headline, but a real structural factor keeping prices supported. Third up is industrial demand, which is booming. Silver is a key input for solar panels, electric vehicles, and electronics. With green tech expansion still strong, consumption on this specific precious metal continues to rise. What's important here is that silver isn't just trading like a safe haven metal. It is trading like a hybrid, both a hedge against monetary policy risk and core industrial commodity. That dual demand is helping explain why it's up nearly 42% year on year. Looking at the charts, silver is riding an ascending channel since April. With prices hovering near resistance, the RSI is slightly overbought, which makes a pullback possible. A slip below $43 could see the support at $42.25 or even $41.30 come back into play. But a breakout above $43.70 could open the door to $44 and even the August 2011 highs near $44.25. Let's finish things off with the Nasdaq 100, the tech giant of indices. After Fed cuts, the Nasdaq surged to 24,648, making fresh record highs. That's a 24% gain over the past year. Despite economic growth slowing, signals of cooling. Well, why? Because rate cuts are like rocket fuel for growth stocks. Lower borrowing costs benefit tech firms heavily. Instead, invested in R&D and expansion. Apple is seeking strong iPhone 17 sales. Chip makers are riding the AI wave, and even delivery companies like FedEx, often viewed as economic barometers, posted strong results, further boosting sentiment. But not everyone's convinced. Futures have slipped about 0.1% as the week just kicked off. Why, you might ask? Well, because traders are now shifting their focus to a barrage of data that is ahead. We have PMI numbers, GDP revision, multiple Fed speeches, and of course, the PCE inflation report on Friday. That's the big one for the week. So if inflation runs hotter than the forecasted 2.8%, the rally might start to look a little bit stretched. In other words, the Nasdaq is living large right now, but its fortune is tied closely to how inflation prints later this week. On the charts, the trend remains bullish, with support near 24,440 and resistance looming at 24,650, and then the psychological 25,000 level. A clean break above 25,000 would confirm momentum, but a hot inflation surprise could quickly turn this rally into an overexcitement. So here's the setup. The Fed handed the market a gift last week with the Fed interest rate cut. But Friday's PCE inflation data will reveal whether it was a wise move or an early misstep. Will equities keep flying, or will the bond market warning prove right? We'll find out soon enough. Tomorrow, we'll zoom in on Fed speeches and how their tone might sway currency markets. And with that, we wrap up your daily market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Simply head over to ATFX Africa by clicking the link in the description and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.